Let's start with the brutal facts. Vechain dropped nearly 97% from its 2021 all-time high. That's not a correction. That's not a bear market. That's capitulation. The token is down 77% since February 2025, down 29% just in the last month, down 15% this week alone. That's accelerating downside. That's panic selling. That's the kind of price action that makes investors emotionally exit positions regardless of fundamentals. And the trigger. October 2025 saw historic liquidation events across crypto. The broader market suffered deep losses. Liquidity dried up. When liquidity disappears, mid-cap tokens and infrastructure plays get hit harder than mega-cap assets. It's not about the project, it's about market structure. When money leaves the entire sector, everything bleeds. Here's what's genuinely important. Vechain has reset to 2020 price levels. Those were prices before the expansion cycle, before enterprise adoption scaled, before partnerships with multinational corporations developed. Think about what Vechain built between 2020 and 2021: enterprise infrastructure, real use cases, actual customer adoption, network growth, technical improvements. All of that is still there. It didn't disappear when the price crashed. So the market is now pricing Vechain as if none of that maturation happened. That's either a massive opportunity or a warning signal that adoption was all hype. Historical precedent suggests it's opportunity. Infrastructure tokens that reset to pre-expansion prices have historically marked accumulation zones rather than permanent collapses. Bitcoin did it, Ethereum did it, Litecoin did it. When the technology still exists and the adoption is real, the price floor eventually becomes obvious. Vechain is now trading sideways near the $0.008 level. That might not sound exciting, but it's actually important. Prolonged sideways action after a steep collapse typically indicates seller exhaustion. Think about the psychology. If you're selling Vechain, you've already taken your losses. You're out. The price falls, panic selling accelerates, and eventually the sellers run out of ammunition. That's when sideways consolidation happens. Sideways action doesn't mean price will suddenly explode upward. It means the downside pressure is weakening. It means sellers are becoming exhausted and buyers are starting to accumulate at depressed prices. That's the foundation that recovery is built on. The model suggesting Vechain could move sideways through early May 2026 actually makes sense from that perspective. Extended consolidation after extreme drawdown is normal. It's how markets reset before recovery begins. Here's the critical distinction that most traders miss. Capitulation is different from collapse. Capitulation is when holders throw in the towel. They accept massive losses. They exit because they can't psychologically handle the pain. That's where we are now. That's what the 77% decline since February and the 97% decline from all-time high represents. Collapse is when the fundamental infrastructure fails, when the project becomes irrelevant, when the use cases disappear. Vechain hasn't experienced that. Enterprise customers are still there. The network is still operating, the technology still works. So what we're seeing is capitulation of retail holders who couldn't handle the pain, not collapse of the actual infrastructure. That's the setup that precedes recovery. Okay, so let's talk about what realistic recovery actually looks like. We're not talking about those moon scenarios, and we're definitely not talking about crash to zero scenarios either. We're looking for that realistic middle ground. In the near term, through May 2026, we're probably looking at sideways consolidation near $0.008. The price is likely to oscillate within a pretty tight range. Seller exhaustion will probably keep continuing, and at the same time, you'll see gradual buyer accumulation. Honestly, this is the boring phase. This is the patience phase. Now, in the midterm, from May to December 2026, we could see a gradual recovery as market conditions start to stabilize, and capital begins to return to crypto. Vechain could be moving toward 2 to 3 cents. It's not going to be explosive, it's going to be methodical. Of course, this all assumes that the broader crypto market stabilizes and investors regain their risk appetite. As for a recovery target, bullish projections put Vechain at around 17 cents during 2026. That's not back to all-time highs, but it is a recovery to roughly where Vechain was trading in mid-2021, before that final euphoria spike. That scenario assumes enterprise adoption continues, capital comes back, and the token gets repriced higher. It's realistic, but it's definitely not certain. Looking at the long term, so 2027 and beyond, some more aggressive forecasts do suggest potential for new all-time highs. But that would require sustained adoption, significant capital inflows, and a real return of institutional risk appetite. That's further out, and honestly, it's a lot more uncertain. Recovery won't happen in isolation. VeChain can't moon while crypto stays in collapse. The conditions required are broader crypto stabilization. The sector needs to move past October 2025's liquidation trauma. Capital needs to return. Risk appetite needs to recover. Without that, VeChain languishes. Renewed enterprise adoption visibility, more announcements, more real-world use cases, more customer wins. That's what separates recovery from dead cat bounces. Macro conditions improving. If traditional markets continue seizing up, crypto stays under pressure. VeChain needs a healthier macro backdrop. Patience from existing holders. If investors panic sell on the way up, recovery gets disrupted. The best recovery scenarios require holders to actually hold. Alright, if this breakdown of VeChain's capitulation versus collapse and the realistic recovery path just changed how you think about evaluating devastated tokens, you need to understand the deeper mechanics of how market cycles actually work. Most creators talk about price predictions and hype scenarios, but there's an entire intermediate layer where understanding capitulation patterns and recovery frameworks determines whether you're buying opportunity or chasing dead projects. If this analysis of seller exhaustion, consolidation zones, and realistic recovery targets helped you see why sideways boring action is actually bullish, smash that like button right now. It tells YouTube this deep recovery analysis matters. And it helps us push this kind of sophisticated market cycle analysis to more people who actually understand how infrastructure tokens resurrect from capitulation. And if you haven't subscribed yet, hit that subscribe button and turn on notifications. When tokens crash and recover, we analyze the actual mechanics instead of cheerleading or doom posting. Let's keep going. I need to be clear about the uncertainty. VeChain trading at 2020 prices doesn't guarantee recovery. Markets don't follow scripts. Macro pressure could intensify. Crypto could remain depressed for years. Enterprise adoption could slow. Competitors could capture market share. Any of those developments could disrupt the recovery path. The 17-cent target is bullish case scenario, not certainty. New all-time highs in 2027 is even more uncertain. Recovery frameworks are educated possibilities, not guarantees. But the key insight is that VeChain didn't become a bad project when it crashed 97%. It's the same infrastructure, the same enterprise relationships, the same technology, the same adoption fundamentals. The only thing that changed was the price and retail psychology. Alright, so here's what I want you to walk away with. VeChain's collapse is absolutely devastating. Down 97% from all-time high, down to 2020 price levels. The psychological and financial pain is real, but price crash doesn't equal project failure. VeChain still has enterprise infrastructure. It still has real use cases. It still has adoption. All of that is still there. The question isn't whether VeChain crashed. It clearly did. The question is whether this represents capitulation, where sellers give up and the price eventually recovers, or permanent collapse where the project becomes irrelevant. Historical patterns suggest capitulation, sideways consolidation through May 2026, gradual recovery towards 17 cents, potential new all-time highs in 2027, but that assumes macro stabilization and continued enterprise adoption. For investors willing to sit through boring sideways action and trust that enterprise infrastructure eventually gets repriced correctly, VeChain at these levels is worth considering. For traders who need excitement and momentum, stay away. Sideways action won't satisfy that. Thanks for watching TJ Crypto World. If this breakdown of VeChain's capitulation setup and realistic recovery framework helped you understand the difference between crashes and collapses, please drop a comment below. Do you think VeChain recovers toward 17 cents or continues toward zero? And before you leave, check out our latest video on how infrastructure tokens survive bear markets. I break down the exact conditions that separate projects that come back from projects that don't. The link is pinned in the comments. Stay analytical, stay patient, and I'll see you in the next one. Peace.